Stocks were higher, bond yields were lower as the Fed takes out the patient language from the FOMC statement. Everything else, though, including the presser, a lot more like a dove, dovier, more dovish. Matt Klein, also of FT Alphaville, is here to talk about this with me. Matt, patient is out, but forecasts for inflation, forecasts for growth, and also for unemployment all were lower. What should we make of this?
So I think one thing that's interesting that Yellen explicitly highlighted during the press conference, during the statement of the press conference, was that there's a shift downward in the median path of interest rates as delineated in the dot plot, and that was because that in general FOMC members thought that growth was going to be slower than they'd been previously projecting. So
is that a structural problem? And if they're saying that growth is going to be slower than previously projected, I mean, presumably they're not saying that they're going to have inadequate monetary policy throughout the time. So doesn't that suggest that there's something deeper underlying problem?
It does. I mean, it fits in with sort of a secular stagnation thesis that trend growth is lower, interest rates should be lower, inflation is going to be the same, unemployment maybe a little bit lower relative to the the force of inflation that or the trend rate of unemployment, whatever. So that, I mean, it's interesting that there's sort of this write-down of the longer-term path of where the rate hikes are going. So even though people, you could focus on, oh, patient is out, therefore this is a hawkish statement. But like actually, if the terminal path of rates is significantly lower, then that suggests that bond yields should in fact be lower. I mean, the start date of the rate hike isn't really as important as where they're going to end up in the future.
Yeah, that's true. Although, I mean, she has explicitly rejected the secular stagnation hypothesis before, right? And under secular stagnation, you'd still have a problem with employment and these other variables too. They're essentially saying that trend growth might be lower, but the labor market might be fine and monetary policy will be fine and inflation eventually will get back towards 2%. That's interesting, but I also want to talk about NAIRU, the non-accelerating inflation rate of unemployment, all right? The Fed has a proxy for this. It's the long-run estimate for what they think unemployment's going to be. Before, it was in a range of 5.2 to 5.5%. But guess what? The actual unemployment rate is now 5.5%. It's touching the high end of that. That's impossible to reconcile with the world in which there is almost no price or wage inflation, and in fact, one in which price inflation at least has been trending down a little bit. So it's interesting to me, they finally lowered their estimates for the long-run unemployment rate. It's now at 5 to 5.2%. That's actually kind of a big difference. And it's interesting because it also suggests that the Fed thinks that unemployment has a little bit longer to go before we're at the so-called full employment, before it hits that part of its mandate. Is that the way we should be thinking about all this?
That's one way to look. I mean, one thing also is that the forecast they have for unemployment for 2016 and 2017, the central tendency is actually a little bit lower than the central tendency they have for the long-term rate, which sort of implies that they expect unemployment to go down. In other words, they want inflation to accelerate, which sort of fits with what we know inflation is, where their target
because
is.
they've been missing the target for 3 years.
It has to accelerate for them to fulfill the target they set for themselves. So it makes sense that they view unemployment as going below the NAIRU. I mean, one thing that I think is hard to give this a weight, but the 5.2, 5.0 number that you cited is the central tendency, which basically you cut out the three extremes at the high and the low end. If you look at the range, it's actually much more stable.
Somebody's very stubborn. They're holding tight to a 5.8% as the NAIRU, which sounds ludicrous.
In the previous time they did it was 5.0 to 5.8. Now it's 4.9 to 5.8. So there's a slight difference. I mean, how much of a shift there really was, it's a little tough to count. But the extreme end.
Okay. Forward guidance, one of your favorite topics. We're done with it, right? That's it? It's over? It's dead in the water?
It seems like
pounded into the dust?
It certainly seems that way. I mean, if Yellen said pretty clearly that they're not interested in providing any additional guidance. They're data dependent. They say we look at the data, we interpret the data. Market participants look at the data, they interpret the data. Let's all be data dependent together. I mean, that's sort of the opposite of guidance in any meaningful way. I mean, everyone has a model in their head of how inflation goes.
The data dependency itself doesn't have to be contradictory to the idea of forward guidance, but you just need to couple forward guidance with a reaction function rather than with a calendar-based thing. There isn't really any of that, and what struck me about the press conference was when she was asked very pointedly a couple of times, when you say you're looking to be reasonably confident that inflation will be headed back towards 2%, what does that actually mean? And she just cited a whole bunch of variables she's looking at. She said there was no mechanical answer So I guess we're looking for what, a spiritual answer, or what's the, you know?
Right. I mean, I think the thing that was probably most striking to me listening to that was when she said, talking about wage growth accelerating. She said, if wage growth is accelerating, then we're probably going to raise rates. But it's not a precondition to raise rates if wage growth doesn't accelerate, which is kind of interesting because she herself highlighted wage growth as an indicator of labor market slack in the past. And so, and that supposedly in turn leading to a predictor of future inflation. So the fact that she's basically saying, well, you know, we can be forward-looking. I mean, I'm going to interpret saying that, you know, even if wage growth is accelerating now, it may accelerate in the future. Therefore, want to raise rates now.
Right.
That's an interesting change. It removes one more piece of information that someone can glom onto in the market and say, oh, like this is the indicator we should be looking at for Fed policy.
Yeah. Okay. So June versus September. All right. We still don't know. June is a possibility, but a lot can happen between now and then. What we learned is that there's a chance now that the slope of rate hikes after the first one, whenever it does come, might well be shallower than the Fed had been forecasting before.
Right.
All very interesting. Thanks for being here. Go to ft.com/Alphaville for more, and we'll see you next time.